A really big challenge that we're seeing right now is that interest rates have gone up so much, and at the same time, house prices are really high. So I hear this all the time. People are saying, well, interest rates back in the day used to be 11% or they used to be 12%, so rates really aren't that bad, but they are bad because at the same time, house prices are also really high. So if you have a 6% interest rate and your house is 100 grand, no problem, right? But if you have a 6% interest rate and your house is also $500,000, that can create a really big challenge with affordability for a lot of home buyers. What's really cool right now though, is that we're seeing more inventory that we have in a really long time, and this creates a lot of opportunities for home buyers. If there's a bunch of houses for sale, sellers are trying to give extra incentives for buyers to pick out their house and buy their house versus their neighbor's house. So what we're seeing is they're offering a concession in the form of a seller credit. And there's a lot of things that home buyers can do with that seller credit. You can use it to pay your closing costs. You can use it to buy down your interest rate. And then one program that we're really starting to talk about a lot right now is called a temporary buy down. So here's how it works. A popular one is a 2-1 buy down, or there's a 3-2-1 buy down. So for your first year, your interest rate's 2% lower. The second year, your interest rate's 1% lower. For example, say you got your mortgage and your interest rate was 6%. The first year it's gonna be 4%, and the second year it's gonna be 5%. And then after those 2 years, it just goes back to the normal interest rate, which is 6. Don't worry, we're not qualifying people off the 4% interest rate or the 5% interest rate, because a lot of people are thinking, this sounds like an adjustable rate loan, my payment's gonna change, and now I'm not gonna be able to afford my house payment. No, we're gonna qualify you on the 6% interest rate. You just get a little bonus the first 2 years because you have a lower mortgage payment. I ran a scenario for a client, and how the numbers worked out with that first year, since their rate was gonna be 2% lower, they were gonna be saving about $500 a month. And then that second year, when their interest rate was 1% lower, they were gonna be saving about $250 a month. So during those couple of years, things can change. What if you're expecting to get a promotion in a couple of years? What if you can use that $500 a month to pay off some debt so that you have less debt when your mortgage rate goes back to the original, the 6%? What if you're not even gonna stay in the house for 2 years? What if interest rates drop in those 2 years and you're able to refinance your loan? A lot of people right now are saying, maybe I'll wait to buy until interest rates drop. That's a good idea, but what if you bought now and then when the interest rates dropped, you just go ahead and refinance your mortgage? So that's where this temporary buy down can come in. If you believe rates will be lower in 2 years from now, use the seller's money, get a temporary buy down, get your interest rate lower today, and then when the rates drop, go ahead and refinance. What I found out that was really cool with this program, so the seller's giving you this credit, right? They're basically subsidizing your interest for those first 2 years. Say you refinance and you don't even get to take advantage of those 2 lower years because maybe interest rates drop in a year from now. You refinance because the rate's lower. That money that the seller paid, you can actually apply it towards the principal of your loan when you refinance, so you're not gonna lose out on that money. I ran a scenario for a client and they were gonna get about a 2% seller credit, and they were gonna be able to use that to do that temporary buy down. And then the other one, that 3-2-1 buy down I was telling you, your interest rate's gonna be 3% lower the first year, 2% lower the second year, and 1% lower the third year. When I ran a scenario for a client and their interest rate was 3% lower, they were gonna be saving $700 a month. And their interest rate was gonna be in the 3s. If your rate was gonna be in the 3s today, would you buy a house if your rate wasn't in the 6s? So this is a really cool program to make buying a house more affordable today rather than waiting. I'm Amanda Ray with Guild Mortgage. If you have any questions about buying a home, I'd love to talk.